All right, listen up. Because the market is doing that thing it does right before people pretend they saw it coming. Futures got smacked overnight. Everybody panicked for about 10 minutes, and then, like clockwork, buyers showed up to clean the mess up. But don't get comfortable. The price action is the easy part. The message behind it is the part that can wreck portfolios. I'm John A.G., and I'm not here to sell you a fairy tale. I'm here to keep you on the right side of probability while everyone else is busy arguing about headlines. I'm recording this on Tuesday, January 27th at 8:12 a.m. I am Eastern New York time, and I want you to comment what time you're watching right now because the timing on this week matters. And real quick, the stats are brutal. Tons of you watch these videos and don't subscribe. If you get value here, hit subscribe so you don't miss the next move. Now, here's what sparked the overnight drop. Another round of trade threat drama aimed at a major neighbor tied to who they might cut deals with overseas. The market's first reaction is always the same. Sell first, ask questions later. But the bigger takeaway isn't the threat itself. The bigger takeaway is what these threats do to confidence. Companies don't invest aggressively when the rules can change in a tweet. Foreign buyers don't lean into long-term contracts when policy feels like a coin flip. And investors don't pay premium valuations when they don't know what the next rulebook looks like. A lot of people love to say it won't happen, so it won't matter. I don't buy that. Even if the threat never becomes policy, the threat still has a price tag. It widens the range of outcomes. It increases hedging demand, and it forces real businesses to build in higher buffers, higher costs, just in case. That's how nothing happens. Still becomes inflationary and still chips away at trust. So you had futures open at 6 p.m. Eastern and they immediately slid. Not a gentle drift, more like someone shoved the chart down a staircase. Then the selling slowed, the bids returned, and price started that slow grind higher that makes bears furious. By early morning, you saw a quick flush. One of those shake out the weak hands dumps, then it pushed back up again. Bottom line, compared to last week's close, we're basically flat. Nothing end of the world on the index level today. But here's the cliffhanger. The flat line is the disguise. The real story is the cross current underneath. And it's setting up a week where the market can swing hard in either direction with almost no warning. Because this week is loaded. We've got a central bank decision midweek with a press conference right after. And if you've been paying attention, the political pressure around that institution has been getting louder. When independence gets questioned out loud, markets don't shrug it off. They get jumpy. So the question isn't just what do they do with rates? The question is, what does the tone do to confidence? And confidence is the oxygen of risk assets. Remember, markets don't just react to the decision, they react to the path. If the message hints at higher for longer, that hits growth stocks. If the message hints at we're done tightening, that can lift equities, but simultaneously raise questions about whether something is breaking behind the scenes. And if the message hints at political influence, that's a different kind of problem. That's the kind of thing that can bleed into currencies, bond auctions, and long-term risk premiums. On top of that, you've got big-name tech earnings stacked up like dominoes. A few of those reports hit after the close midweek, and another one hits the next day. That matters because when mega-cap tech sneezes, the whole index catches a cold. If they guide soft, it doesn't just hit one ticker, it hits sentiment. And if they surprise to the upside, it can rip shorts to pieces. Either way, volatility is basically scheduled. And there's another layer most people ignore, options positioning. When you have a week with a major policy event and mega-cap earnings, dealers hedge aggressively. That can create these weird sticky price movements where the market feels pinned and then suddenly unpinned. So if you feel like price is calm and then it explodes out of nowhere, that's not magic, that's structure. Before we go deeper, quick reminder. Check the description for bonus links, including the premium WhatsApp channel link and the channel membership join link. If you want faster updates and deeper breakdowns, that's where you'll find them. All right, charts. Let's start with the broad index. There's a big structure here that's been acting like the market's invisible fence. When price approaches it from below, it's been capping rallies. When price falls toward the lower boundary, it's been catching pullbacks. And until that structure breaks cleanly, you respect it. I don't care how smart your macro thesis is. If the chart says no, you wait. This is one of those structures where it doesn't look important until it saves you. It's been marking major turning points. Tops where euphoria gets punished and lows where fear gets harvested. That doesn't mean it's permanent. It means it's working right now. And when something works right now, you use it until it stops. Now add the second layer, an upsloping trend line that stretches back to the spring lows. That line has been a clean guide. Multiple touches, clean bounces, predictable behavior. And recently, price slipped underneath it. Not a full-blown collapse, but a break, and here's the part people miss. The first break is often the warning shot, not the knockout punch. Confirmation is what you watch next. So right now, we're sitting in a spot where the index is under two different lines that used to provide support and resistance. That tilts the bias slightly negative until proven otherwise. Not panic, not sell everything, just keep your head on a swivel. And if you want one extra clue that's easy to watch without fancy tools, look at breadth. When the big index is flat, but fewer stocks are participating in the rally, that's fragility. When the equal weight version lags while the mega caps carry everything, that's concentration risk. Concentration can keep the party going, but it also means if a few names stumble, the whole room gets quiet fast. Now look at the tech-heavy index. It's been even more telling. It actually gave a cleaner downside confirmation, close below, then followed through. And then what did it do? It started doing that classic move traders call a retest. Price comes back up toward the level it broke from, like it's walking back to the scene of the crime. This is where a lot of people get trapped. Bulls see the bounce and assume the trend is saved. Bears see the bounce and panic cover too early. The market loves that confusion because the retest is where you find out if the break was real or fake. If it rejects, that's when downside can accelerate. If it reclaims, that's when shorts get squeezed and you get one of those face-ripping rallies. And that's why the earnings timing is so dangerous. If those reports don't impress, the retest can fail and roll over hard. If they do impress, it can reclaim the line and trap bears who got too confident. Either way, the move after the decision can be larger than people expect because positioning is already tense. Now, pause, because here's the part that should make you raise your eyebrows. While the indexes are playing tug-of-war, the metals market is acting like something's wrong. Silver is not moving like a normal commodity right now. Gold isn't either. And when both are surging, you have to ask the uncomfortable question. What are people running from? Here's my read, and it's not about hype. When tariffs get floated randomly, even as threats, it injects uncertainty into supply chains, companies can't plan, investors can't model, and foreign governments start asking themselves, do we really want to keep financing this? That's how confidence erodes. And once confidence erodes, capital looks for exits. Not always the fastest exits, sometimes the safest looking exits. Let me add a second reason that doesn't get enough airtime: real yields. When inflation expectations are sticky and policy rates can't stay restrictive forever without breaking something, investors start doing the math. If you're after inflation return on cash and bonds starts looking thin, hard assets suddenly look less speculative and more defensive. That's when gold and silver stop behaving like trades and start behaving like insurance, exactly when you least want to be underinsured. We've talked before about how a country's currency stays strong, not just because it's used, but because it's trusted. And lately, we're seeing stress signals. Based on recently published numbers, global reserve allocations have been shifting slowly for years. It's not a flip the switch event, it's a drip. But enough drips can flood a basement, and you can see it in the dollar chart. Last week's drop wasn't pretty. This week, it's trying to follow through. The dollar is clinging to a support shelf that's been there a long time, and if that shelf cracks, no, it doesn't mean the currency goes to zero overnight. It means the downtrend becomes the new normal. It means your buying power bleeds out through 1,000 tiny cuts. Here's the scary part. A slow decline is politically easier to tolerate than a fast crash. So it can go on longer than people expect. That's why I call it a confidence leak. It doesn't blow up the house, it rots the foundation. You don't notice it until the floor starts sagging. And while everyone stares at the stock ticker, the bond market is whispering. Sometimes it whispers calmly. Sometimes it whispers like it's trying not to scream. Watch the long end of the curve. When longer-term yields rise while the dollar falls. That's not a healthy growth story. That's a credibility story. It's the market saying, if I'm going to lend you money for a decade, I want to be paid more because I'm not sure what my dollars will be worth when you pay me back. That's why treasury auctions matter more than most people realize. If demand is strong, yields can stay contained. If demand softens, yields drift up. And rising yields don't just hit government borrowing costs, they hit mortgages, car loans, and corporate refinancing. That's when the real economy starts feeling the market's opinion. Historically, when the yield curve inverts and then begins to uninvest, that's often when trouble shows up, not when it inverts. It happened around the early 2000s. It happened again heading into the late 2000s crisis. The inversion is the warning, the steepening is the punchline. So here's a question for you. Are you watching the bond market at all, or are you only watching stocks? Drop a comment because I want to know how you're tracking risk. And here's the second question. If you had to pick one thing to protect this year, your purchasing power or your portfolio value, what would you choose? I know that sounds dramatic, but that's exactly the trade-off people get forced into when inflation and growth start fighting each other. One more under-the-radar tell: spreads. When lenders start demanding more yield to own corporate debt, that's stress building in the plumbing. You won't see it on the front page. You'll see it in the cost of money. And right now, you can also feel it in volatility pricing. When implied volatility stays elevated even as indexes drift sideways, it's the market admitting it doesn't trust the calm. It's like driving through fog with your foot hovering over the brake. You can keep moving, but you're ready to react. So if you see the index doing nothing and you wonder why metals are ripping and the dollar is sliding, remember this. The market can look quiet on the surface while the internal pressure keeps rising. That pressure eventually finds a release valve. And if you're wondering where the next surprise usually comes from, it's not the headline you expect. It's the reaction. A good decision that gets sold off. A bad report that rallies. That's the market telling you positioning was the real story. So don't just listen to what they say on Wednesday. Watch what price does in the first hour after. That first hour can set the tone for the entire month. And if that hour flips, you'll feel it everywhere fast. Now zoom out to other currencies and the contrast gets loud. You're seeing breakouts against the dollar in multiple places. Not a perfect line, not a straight shot, but clear technical behavior. Base, break, pullback, and then continuation. That's market language for the trend is changing. Even the Canadian currency has been carving out a pattern that traders respect, a reversal structure that often shows up near turning points. If it triggers, it suggests relative strength versus the dollar. That doesn't mean one country is winning. It means capital is repricing risk and stability perceptions. And if you live in the US, that can show up as higher prices on imported goods from machinery to electronics to everyday items you don't even think about. And the British pound, similar story. Big level cleared, pullback held, and now it's leaning higher. It's like watching multiple warning lights flash on the same dashboard. One light could be a glitch. 3 lights means you pull over and check the engine. Now, to be fair, not every currency is acting strong. The Japanese currency, for example, has had its own long-term issues tied to debt and policy choices. Debt to GDP ratios matter. And history shows that once that number gets extreme, it narrows your options. You can tax more, cut spending, inflate it away, or hope growth bails you out. Growth rarely bails you out on schedule. And here's the historical context that matters. Reserve currency dominance isn't forever. The world has seen transitions before. The handoff from the British system to the American system took decades, not weeks. It involved wars, debt accumulation, and shifts in trade. So when people say the dollar can't be challenged, that's not analysis. That's faith. Markets don't run on faith forever. Now, I'm not saying tomorrow morning everyone wakes up and uses something else. That's not how it works. It's more like this. First, some trade deals get settled in other currencies, then some reserves get diversified, then some borrowing costs creep higher. Then the cost of servicing debt rises, and then the politics gets uglier because choices get harder. That's the snowball. It starts tiny, but gravity doesn't care. And that brings us back to the bigger picture. Debt and credibility. The government spending trajectory isn't a secret. From recent market updates and publicly available fiscal data, deficits have been sticky, even in good times. That means when bad times hit, the math gets uglier fast. And markets eventually don't argue with math. They punish it. Now, here's my counterpoint to the crowd that says, relax, the market always bounces. Yes, markets can bounce for a long time. They can grind higher while the underlying situation deteriorates. That's not bullish evidence. That's a reminder that timing is brutal. The car can run for miles with a warning light on. Then one day it doesn't. So I'm not here to claim I can time the exact moment the music stops. Nobody can. But you can recognize the direction of travel. And if you recognize it, you prepare. Preparation is the edge, not prediction. And if you're new to this channel, here's how I think about it. I want a map. I want levels. I want to know where I'm wrong. If I don't know where I'm wrong, I'm not trading. I'm gambling. And this week is not a week to gamble. It's a week to be surgical. Now, let's go straight into the headline move. Silver. Silver pushed above 110. Let that sink in. Not a little pop, not a normal rally. This is a momentum stampede. On a monthly view, it's been stacking green bars like it's trying to break a record. Silver is also tricky because it wears 2 hats. It's monetary to some people, industrial to others. That means it can get pulled by fear and by manufacturing demand at the same time. And when those forces line up, the move can look irrational until you realize it's 2 markets buying at once. And when you get that kind of vertical action, traditional tools start failing. Lines that used to matter stop mattering because emotion overrides structure. That's why you have to treat this like 2 markets at once. There's the investor market, long-term holders who see it as protection. And there's the momentum market, traders chasing because the last candle went up. When the momentum crowd takes over, reversals can be violent. So how do you even map it? One way is to shift your lens. A logarithmic view can help because it respects percentage moves more than dollar moves. And when you do that, you can sometimes find an old slope, an upper boundary tied to historic peaks that gives you a rough ceiling zone. Rough, not perfect. But it's something. When I do that, the area just above current price becomes the first place I'd expect to fight. Not because it must reverse, but because that's where older supply could show up and where late buyers can get trapped. And if we get a sharp wick, that wick becomes a signal, a warning, a message that says the easy money is done for now. Here's the cliffhanger inside the silver story. The next big move might not be up or down, it might be sideways. And sideways after vertical is how markets reload. Sideways is how they frustrate both bulls and bears. And then when everyone stops paying attention, that's when the next leg hits. So don't just watch price, watch behavior. Watch whether pullbacks get bought quickly or slowly. Watch whether volume fades or stays elevated, but don't miss this. Even if silver pulls back, that doesn't automatically kill the big story. It can be a reset, not a collapse. In momentum markets, pullbacks are how the trend survives. The dangerous moment is when pullbacks stop being bought and rallies start getting sold into. That shift can happen in a day, and that's why you respect the chart, not your emotions. Now gold. Gold's move has been huge, but it's been slightly more chartable. It ran up into a major zone, then slipped back under a parallel that had been guiding price, and now it's flirting with that line again, like it's deciding whether to accept it as resistance. If gold ends the day with a long upper wick, a topping tail, that's a classic sign that buyers tried, got rejected, and sellers showed up hard. That doesn't mean gold is dead. It means short-term risk increases. It means the next few sessions matter. And I want to be crystal clear. I treat gold differently than a trade. To me, core gold holdings are an insurance policy. You don't cancel your insurance because you had a good month. You keep it because the risk you're insuring against doesn't send you a calendar invite before it shows up. Could gold pull back 500? Could it pull back more? Sure, markets breathe. Gold has done this before. Go back to prior bull phases and you'll see violent pullbacks that later look like tiny dents on a longer-term chart. But unless we see a real shift toward fiscal discipline, actual restraint, not speeches, the long-term pressure remains. That's the logic. Here's another cliffhanger. If markets ever force austerity, the cure can look worse than the disease. Because when spending gets cut hard, growth slows, layoffs spike, and credit tightens. That kind of forced adjustment can turn a recession into something darker. It's why policymakers often choose slow inflation instead. It's quieter. It spreads the pain out. It makes the numbers look better while living costs feel worse. Now, let's pivot to the miners. When metals go parabolic, mining stocks can either explode higher or start flashing warning signals. Why? Because miners are businesses. They have costs. They have margins. They have labor expenses. They have energy bills. And they have investors who love to take profits when charts look stretched. There's a major mining name that's ripping today. It's approaching a level where prior trend support broke. That broken support can become future resistance. If price tags that zone and stalls, that's where short-term traders start eyeing fades. Not because the company is bad, but because the chart is extended and crowd psychology repeats. The broader miner ETF is doing something similar, pushing right back into a line that matters. This is one of those decision candle moments. If it blasts through, it can run. If it rejects, you can see a sharp pullback as overheated positioning unwinds. And here's a nuance that matters if you actually hold miners. Rising energy prices can squeeze margins even when metals prices are up. That's why miners don't always track metals perfectly. In some cycles, energy becomes the silent tax on the whole sector. So keep an eye on oil and fuel costs, not just gold and silver. While we're talking commodities, notice the split personality. Some industrial metals have been surging, which can be inflationary, but copper has been hesitating. Copper is often called an economic thermometer because it's tied to construction and manufacturing. When copper stalls while safe haven metals rip, it can hint at a strange mix. Inflation worries plus growth worries. That's not a comfortable combo. That's the kind of combo that makes central banks nervous and makes investors reach for hedges. Now, let's swing back to the stock side because earnings are the near-term detonator. One major social platform stock bounced off a long-term trend line into its report. That's the kind of setup where the market is already leaning one way. A good report could run it into a gap fill zone above. A weak report could break that trend line. And once a trend line breaks after multiple touches, the move can be fast. If you're trading it, you don't hope, you plan. Also, pay attention to how the stock behaves after the first move. The first move can be a trap. The second move is often the real one. You'll see an initial spike, then a reversal, then a grind. The market uses earnings to reprice, but it also uses earnings to clean out bad positioning. So don't just watch the headline, watch the follow-through. A major software giant is another one. It bounced off support, but there's a big gap that acts like a magnet over time. Old traders used to tell me gaps want to get filled. Not immediately, not always, but eventually. And when price starts drifting toward that open space, it can accelerate as algorithms and human traders both start targeting the same level. So even if it pops on earnings, that gap area becomes a natural place for sellers to show up. And if it breaks down first, the magnet effect can pull it lower faster than people expect. This is where discipline matters because the market will bait you into chasing at the top of a candle and then punish you 5 minutes later. Then you've got the electric car giant still riding inside a rising channel. It tried to break down, failed, and reclaimed. That's a tug-of-war chart. If earnings push it above the upper boundary, it can sprint. If earnings push it under the lower boundary with confirmation, it can slide toward the next support zone where buyers historically showed up. Again, plan the levels. Don't fall in love with the story. And yes, there's another mega name reporting after that, and it matters, because when the biggest weights move, the index moves with them. That's why this week can feel calm until it suddenly isn't. The market can look sleepy and then in 1 hour redraw the whole week's chart. Now, oil. Here's where I want to challenge an assumption. A lot of people think oil has to catch up because other commodities ran. Maybe, but oil is its own beast. Supply, geopolitics, demand expectations, and production discipline all collide here. If global growth slows, demand forecasts get revised and oil can stay stuck longer than impatient bulls can tolerate. That's the part nobody wants to hear. That said, the chart has improved. You saw a breakout attempt, then a pullback that didn't fully fail, then a push higher. That's constructive. And you're right to watch for capital rotation. Big money rarely goes to cash and stays there. It rotates. When something gets overcrowded, the next underloved trade becomes attractive. There's also a portfolio logic angle here. When metals get crowded, institutions sometimes look for related hedges. Energy equities can be a hedge on inflation and a source of cash flow. Some of these companies throw off dividends that can look attractive when bond yields stop compensating you for inflation risk. So rotation into energy isn't crazy, it's plausible, just don't confuse plausible with guaranteed. Natural gas is the opposite story. It's been a roller coaster. The front month contract spiked hard, partly on weather, partly on positioning dynamics that can turn a normal move into a squeeze. When the nearest contract gets tight, price can behave like it's possessed. But seasonality matters. As winter fades and storage rebuilds, the pressure can ease. That's why I'm cautious chasing gas after a vertical spike. Could it go higher? Sure, but the risk reward starts changing fast when you're late. When everyone is suddenly a natural gas expert, that's usually when the easy part is behind you. Longer term, though, there's a real structural conversation happening. Data centers, electrification, and grid stress are not imaginary. According to the latest publicly available filings and project announcements, power demand growth is a major theme. Gas can play a role in bridging that gap when the grid can't. That's not a next week trade, but it's a real backdrop. Now let's talk about the digital asset space. Bitcoin recently slipped under a guiding channel line, and that can be the first step in a bearish flag playing out. If it can't reclaim that line quickly, the odds shift. There's a nearby support level that could catch a bounce. But if that breaks, the chart opens up toward a lower zone where buyers previously defended. And I want you to watch something subtle, how Bitcoin reacts on days when equities are flat. If equities are quiet and Bitcoin bleeds, that can be risk-off behavior under the surface. If equities dip and Bitcoin dips harder, that's leverage getting reduced. If equities rally and Bitcoin can't lift, that's a warning that the rally might be narrow and fragile. Here's the retention kicker. If Bitcoin weakens while gold and silver stay strong, that tells you something about what kind of fear we're dealing with. It suggests people aren't just chasing risk on, they're choosing their shelters. And that choice can ripple through everything. Stocks, bonds, currencies, and commodities. So what do we do with all of this? We acknowledge reality. It's a high volatility week. Central bank decision, major earnings, metals on fire, currency markets shifting, energy markets splitting into calm oil and wild gas, digital assets testing key levels. That's not a set it and forget it environment. That's an environment where you keep your risk sized appropriately and you stay flexible. And I want to make this practical. If you're building wealth, focus on process over prediction. Identify the key levels, decide what would change your mind, keep position sizes sane, and don't let one candle convince you you're invincible. Also, if you're successful, share your success story in the comments so others can stay motivated. Seriously, people underestimate how powerful that is for the community. One more quick thing about membership, because a lot of you have asked, we do members-only videos produced by a separate team that goes deeper with more research and more charts, and those are only for premium members. If you want that extra layer, the join link is in the description. Now, here's what I'm watching into the close and into midweek. The big question on the broad index is simple. Can it reclaim those broken lines, or does the retest fail? If it fails, downside can speed up fast because markets don't fall smoothly. They fall in pockets when liquidity steps away. Next, I'm listening to the megacap earnings guidance more than the headline numbers. Do they confirm strength, or do they reveal cracks in pricing power and growth? One bad quarter can be excused. A weak outlook usually can't. If they beat but the stock sells off, that's the market revealing expectations were even higher already. Then there's the dollar. Does it defend that support shelf, or does it start slipping underneath? If it breaks, metals don't just stay high. They can accelerate, and suddenly the news starts chasing the chart. I'm also watching how silver behaves at these levels. Do we get a blow-off wick, or do we consolidate and keep climbing? A wick is a warning. A tight range is a spring. Same for gold. Rejection with a bearish tail versus absorption and stability above key lines. That tells you whether this is a speculative burst or a deeper confidence shift. And finally, Bitcoin. Quick reclaim of the broken channel or a confirmation of the breakdown that drags the whole crypto complex lower. Even if you don't trade it, it feeds the mood. And we're going to navigate it one level at a time. No ego, no, I'm always right. Just probability, risk management, and staying awake while the market tries to lull everyone to sleep. If you're successful, share your success story in the comments so others can stay motivated. And if you've been watching for a while and you still haven't subscribed, do it now because the next big move doesn't wait for you to get ready. All right, that's it for today. Stay sharp, take care of yourselves, and I'll see you in the next one. And just so we're clear before you run off and place trades, this is educational content based on how I interpret charts and market behavior. I'm not telling you what to buy or sell, and I'm not your financial advisor. Do your own homework. Know your risk.